Okay, welcome to our afternoon session. I hope everyone had a nice lunch. So we're going to shift gears a bit here and go to our financial market outlook. So I'm going to call up our three panelists. We'll go in order with some prepared comments and then take questions on the panel at the end. So first, Chris Gannatti, Head of Research for Europe with WisdomTree Asset Management. Also, Rick Mastain, Managing Director and Portfolio Specialist with Jennison Associates. And lastly, Joe Zidle, the Investment Strategist with Blackstone. So while we take our seats, I'll turn the floor over to Chris for our first set of comments.
Thank you very much, everyone. It's an interesting time for me personally, as I just make sure that the clicker is operational. I don't know if the clicker is operational, but But anyhow, I just moved to Europe from New York, or from New Jersey. So I now live in London. I lived in London for 1 month. So it's been a pretty remarkable transition on the personal front. But it's great to have the opportunity to be here today. Over the course of the 15-minute session, I was going to talk about two things in particular. One, a way in which my colleagues and I have determined in thinking about risk in the equity market. And then secondly, followed up by some currency-focused comments, a focus on the US dollar versus the euro, as well as the yen. So in thinking about risk, what we have on the screen here is probably the most widely publicized, very, very simple to look at. It gives you essentially one number. And we saw it spike up remarkably in February. But it's merely one way to look at the picture. The way in which we've come up with, and what we're looking at here are the pairwise correlations of all 500 stocks in the S&P 500 going back through time approximately 10 years. And we've overlaid some sort of interesting bouts of monetary policy on top of this. So we see, and we're looking at essentially a 6-month moving window. We look back and we see that correlations tended to get quite high, and then the Fed would step in and do a variant of quantitative easing, and then correlations would drop. And in some versions of this, we overlaid the equity market returns, and as correlations were dropping, returns were generally quite good, and as correlations within the S&P 500 stocks were rising, correlation or returns were not as good. And the reason that we were thinking about this was from an asset allocation perspective. We tend to think a lot about volatility. We tend to think about the capability of risk reduction. And it becomes interesting if you track this measure in different equity markets around the world. Because if you were to say, for example, if the U.S. Correlations were quite high relative to history, but if you look at European markets or Japanese markets and correlations are lower, from an asset allocation perspective, if you're building a diversified portfolio, if you're adding in lower correlation groups or baskets of stocks, your overall asset allocation could be said to be more diversified. And if you're adding in stocks that are exhibiting higher degrees of correlation, obviously in those markets, if everything is moving in the same or substantially similar direction, then ultimately you're less diversified. And so you see that very recently it went up about 3x. So it was at about 0.1, which was at or near the lowest that we'd seen over the last 10 years. And now it's at 0.32. And that's a significant hike, and it points to how in the coming pages what we did was we fashioned an indicator. So you could look at this on rolling 3-month, 6-month, 12-month basis, and you can ultimately figure out the rate of change. You could figure out, is the 3-month going up a lot, but the 6-month and the 12-month aren't? You can figure out essentially a signal, and what we did was we applied that to, as you see here, the MSCI USA index going back to basically December of 2001. And what we see is if you simulate a strategy and you just say, if the indicator is on, meaning that correlations have been rising and risks are thought to be higher, you put the money in cash, and if the signal is off, the white parts of the chart, then you're just sitting in equities. You see that the return goes from 5.3 to about 9.3, and the standard deviation drops substantially. And in 2008, when we know the market was down 37 or 38%, you would have been down 12% following, again, this strategy. And we did the same for the EMU index and saw a very similar result overall. So it's just another way to think about risk. And for those of you who might be less familiar with WisdomTree, we spend a lot of time thinking about building different index strategies, many of which that ETFs ultimately track. The ETF world is bifurcated in the sense that you've got your Vanguards and your iShares tracking the market cap weighted indices, and then you've kind of got a number of other strategies that do a variety of things not market cap weighted, and that's really where WisdomTree falls. And creative ideas like this sometimes find their way into different investment systematic strategies that then ultimately can be accessed with ETFs. And so the US dollar, for me, this was an exercise in humility, because if I were honest and if I were to come here in the beginning of 2017, I would not have said the dollar was going to weaken. I would have said the dollar was going to strengthen when I would listen to various reports. That's what most of the reports were saying, and yet what we see on the screen is the dollar. This is just against the G10, but you can obviously widen the universe. The dollar weakened against basically everything in 2017, and then the euro is right there at the top of the list, appreciating more than 14% against the dollar. And so the exercise was really aimed at what went wrong in terms of our analytical framework, and most of where that divergence probably came was a misinterpretation of this concept. The dotted lines represent the policy rate differential. If it's going up, that means very obviously that the U.S. is raising rates. The Eurozone, ECB, as well as Japan are not raising rates, and the differential is widening. And many times people will refer to this as carry. And as carry increases, one would think if it's increasing in favor of the U.S. dollar, the dollar should be appreciating against the other currencies. And yet, what these solid lines represent, and they're rebased to 100 on the right-hand axis, they represent essentially the dollar dropping in value versus both the euro as well as the yen. And that's what we all know to have happened in the last year. Now, if we look at it a bit differently, one sort of interesting aspect is thinking about the difference between policy communication, that's just fulfilling what's already been communicated, versus genuinely new expectation. And in this case, the dotted lines now represent the difference in the United States. So in the United States, we're taking the 1-year overnight interest rate, and we're taking the 1-month overnight interest rate levels. And the difference between those things is then being measured against the same levels in the Eurozone as well as Japan. And if the dotted lines are dropping, that means expectations of future policy change, meaning interest rates going up in the Eurozone or in Japan, are widening faster than in the United States. So on an absolute basis, what everyone saw every day in the central bank action, of course the US was raising rates, and of course Europe and Japan were not. But certain things were happening in 2017 that were leading people to, over the coming 12-month period, shift their view, shift their expectation. That was the surprise. The US raising rates and the others not was not the surprise. And so it was the surprise that was more correlated, as you see, to the solid lines with the ultimate experience the market underwent, which was euro strength as well as yen strength. Now, another factor was if we think about the valuation of currency, and there are many ways to do this, this is purchasing power parity, we see how extreme 2013, 14, and a bit of 15 really was. We went from essentially, and this is looking at the DXY index, so a mixture of developed market currencies, mostly euro and yen, we see that the dollar went from a discount to purchasing power parity to an extreme premium to purchasing power parity, traded in a range for a while, and then in 2017 dropped dramatically, but it's still not below the purchasing power parity level. So we're still at a premium, but less of a premium than we were, and it speaks to the fact that from a valuation perspective, maybe 2017, in addition to reflecting in different future policy rate expectations, was reflecting in a change in valuation within the currency markets. Then what could be among the more interesting layers to the story was you have the relative growth differential. And so what the lighter blue line is representing is sort of the trend growth of the United States versus the rest of the world. So obviously if it's sloping up, it means the U.S. is growing faster relative to the rest of the world. And if it's flat or sloping down, it means that the U.S. is growing the same as the rest of the world or growing more slowly than the rest of the world. And you see that there is a significant relationship between that trend growth differential as well as the US dollar real effective exchange rate, which I know we saw in one of the presentations earlier today. And so the US growth relative to the rest of the world clearly has slowed down a bit, and that could be another factor that would go against dollar strength and towards dollar weakness or dollar just staying basically at the same or similar level. Then we have the Trump election, and in a lot of ways, the Trump election dashed the market's hopes in the sense that we all start off and we see that the Republicans hold the Senate, they hold the House, they hold the executive branch, and so all the types of reforms that people had talked about during the campaign and otherwise were going to be easy and just immediately happen. And of course, as we heard in earlier presentations today, that did not occur. And what you see is the euphoria of that reflected in the Citi FX positioning alert indicator. We see that long dollar positioning got quite strong around the time of the election and inauguration. But then as it was indicated earlier today, people focused on, for instance, healthcare. We see that the market participants reflected in this index got less and less and less long and less bullish on their expectations of the US dollar. So market participants repositioned largely away from the dollar as 2017 transpired. Then we had some other aspects. Now, currency markets, they're never just one direction or one-sided. Within Europe, and especially after the Trump election victory, which definitely I was living in New Jersey at the time, felt like a surprise for sure. You had then the series, the wave of European elections set to come. And what we see here is the Euro-USD 3-month implied volatility. We see that it was quite high, and the French election essentially was a key signal, and how that election went was going to be quite important for the trajectory and the perception of risk for the rest of the year. And we all know the direction that the first round and second round took at that point in time last year, and as a result, it opened the door to investment practitioners becoming long the euro yet again, and that positioning being far less risky over time. So factors like this open the door to the potential for euro strength as yet another example of something that happened in 2017. Then if we look at the average of what happened over the past 5 hiking cycles, and what's interesting about this, and I feel like generally when I listen to, be it CNBC or other outlooks, maybe people just don't realize this, frequently, and it was predominantly last year, you would hear statements that the Fed was going to act a certain way, move a certain way, do certain things they do exactly that, and the next sentence was usually the dollar is going to respond in this way. And 98% of the time, the dollar would have to go up because the Fed was moving in this more normalizing type of fashion. And yet, if we look back across time, that has most certainly not happened in essentially on average going back to the 1980s. Usually, when the Fed has been on a hiking cycle, the dollar has actually weakened, and that's really what this chart represents. So that doesn't mean that when the Fed is hiking rates, the dollar never strengthens. It just means in sort of the current historical regime in which we find ourselves, it's almost as though the expectation of the hiking already built in the strength before the actual hiking actually transpired. Maybe that's one way of potentially interpreting or thinking about it. And then finally, we have inflation. And if inflation is ticking up, if inflation is truly going to be a more significant concern, that should ultimately trend more towards dollar weakness than dollar strength. And maybe, we were just at lunch, maybe inflation is going to be much higher than many market practitioners expect, and what we're seeing is an adjustment in that particular direction. And the final slide is meant as sort of an interesting way of encapsulating this concept, which we'll see if it bears to be true. I know there were some remarks this morning which would imply that maybe that next recession occurs in Japan and in Europe before the United States. Maybe it doesn't. But what this chart ultimately implies is in the latest regime, going back to essentially the mid-'80s, you've seen the United States usually emerge first from any sort of economic downturn, and then a lot of the other markets around the world, be it the UK, the Eurozone, or Japan, essentially act in ways to catch up, and maybe that's part of what we're seeing now, where the market is factoring in how, if in fact Europe is growing faster, the UK is growing faster, Japan's growing faster, if that's the proper interpretation, then the market is looking forward towards those central banks acting. The Fed is merely on a path doing what it has already communicated or already said it would do, and that could be where we find ourselves. So in looking forward, what we were attempting to do was perform an exercise to maybe understand just a small amount better what happens in currency markets and how we might interpret things going forward. Thank you very much.
Which one is it, Chris?
So it's the clicker, and you'll want to,
That one.
oh, if you have it. Thank you.
Okay, good afternoon. I'm Rick Mastain from Jennison Associates, and very much appreciate the chance to be here. Maybe a perspective on where I'm coming from, and then get into the presentations. We've managed growth stocks since 1969, so we've had a very unique perspective on a lot of innovation in the U.S. And but it's always important to have a time perspective as well. So I thought we'd start with this. Just two well-known market commentators. One saying, "Don't be long over the weekend." It's a pretty short-term phrase. And of course, Warren Buffett, "My holding period is forever." So today we'll kind of try to hit that sweet spot of the next 12 to 18 months. Is really more of our outlook. But look, there's always things to worry about. Whether it's headline concerns, macro uncertainty, 6 months ago would have been Korea. There's always plenty of things to worry about. The midterm elections is something that we talked about in a small group earlier this morning, where it's today probably a 50-50 or close to 50-50 chance that the Republicans hold the House. Again, we're not making any forecast. 6 months ago it would have been 90-10 or something of that sort. So we're very much fundamental, but always aware that there's things to worry about. But generally speaking, we're very optimistic. And I won't go through every point, but there are a lot of reasons, some of which you've heard today, to be optimistic about, the outlook for, in this case, U.S. equity markets over the next, 12 to 18 to 24 months. A couple of things I'll point out here. I'm going to talk a little bit about disruptive technologies or disruptive
penetration rates of technologies. 2 points here I'd mention is tech is the new macro. Now, we don't mean that technology leads everything, but I had a brief conversation with Kathleen after lunch about thinking about wages and how technology is used, and we use McDonald's as an example. Clearly, they're not reinventing the wheel. It's clearly not a technology company, but the way they're addressing wage pressures. If you have a chance, it's fun to see. Walk into a McDonald's and you'll see the kiosk, which allows you to order your meal much more quickly. And also the big winner there, people feel it's much more efficient. So the payback on that investment is a 17-month payback for McDonald's. It helps them say, yes, we are raising minimum wages to $15, but of course, there are much fewer people at the front of the store getting that minimum wage. And then the other point I'd mention here is, my phrase, war on business is over. And what I mean by that, it's been a long time. You can each think in your own mind about how long it's been. But we went through, and all due respect to the previous administration, we went through at least 8 years, and possibly even the Bush administration was so focused on the terrorism issues. It's been 16 to 18 years since business had a kind of the wind at their back in the U.S. And measure that by optimism of the small business owner hasn't been as high in 50 years. Optimism of the consumer is at all-time highs, or highs going back for long periods of time. So that allows you as a small business owner, and by that I mean 100 employees or less, which is really the backbone of our economy, to feel very good about making capital investments or hiring people. This is more information than you need, but our point here simply is that the core belief that I think most people would share is that over long periods of time, earnings will drive share prices up or down. The idea is to find companies that are growing quickly. And while you can argue what the rate of change is I use the S&P as an example, this is pre-tax reform. The numbers are pretty compelling. With tax reform, the street estimates, as you know, for S&P earnings this year are 20%, and probably 13 or so without tax reform. So we're in a period of not unusually high, but higher than average growth for markets in general. One thing that's really interesting is that, to the point earlier about what's to worry about, I mean, I think probably because of the duration of the bull market, the strength of the economy, the fair question to ask is, how long does this last? Now, I'm being a bit facetious in the sense saying, are we due for a major correction? There's always something to worry about. And while that is a question front of mind, it's not in the cards, we think, at all. I mean, usually it's due to major excesses, geopolitical events, et cetera, but we don't think that's in the cards at all. And really more back to my comment on the fact that it's really a time to be optimistic, and we think very few investors, or not enough investors, really get that, to the point that there's very little risk-taking in U.S. equity markets. This speaks to that very point on risk-taking, using a PEG ratio. You'd think intuitively this chart should be upside down, because the PEG ratio, meaning the growth to the valuation, is actually very, very attractive for the faster growers, as you see at the bottom here. Now, you could have some of the names that are more the bond proxy stocks, et cetera, utilities, selling at very high valuations, and there certainly is a place for that safety. But what's really interesting to us is that you can own a lot of these faster growers and really not have to pay for them in a big way at all. This is another way to break that down. Again, a chart like this is sometimes surprising to folks, because it says again, going back a long time, this is basically back to when the Russell 1000 growth as an index started, but roughly 30 years. and showing the valuation of large cap technology companies selling at basically a valuation that's less than they've sold at in many, many years, or certainly less than the average. So this is, again, not not front of mind with people. It's very counterintuitive, and it shows the duration of growth that a lot of these, I'm not going to say new companies, but a lot of these large growth companies have. And I refer to, a lot of the, obviously the FANG stocks, but stocks outside of that, like a Boeing, for example, Home Depot. Some of these are really disruptive in the sense that they have changed the way people do business, and they still have, we think, very long paths. What's going on, again, I won't read every point, but there's disruptive events occurring across the landscape. So you kind of go from the top to the bottom. Apple is pretty well known by everybody, to Tesla at the bottom, but just to speak about Apple for a moment, it's really interesting since it's a company that all of us, or most of us, know and use their products. What's driving their growth today is not just product, but it's the sustainability of revenue. So if you think of Apple going way back, it was, how many phones did they sell? You wake up every morning and they hadn't sold any phones, or any iPads, or any iPods, or whatever it happened to be. Today, nearly 20% of their revenue comes from the recurring revenue that we pay for our Apple apps, for our iPhones, and that number, last quarter was about $10 billion. So this is where people give Apple a much longer growth path than what you might normally think about. What we think is really interesting is if you even go down to some of the disruptive technologies, the whole thing about electric vehicles. It's in our view not an if, but when. If you look at even the material stocks that benefit from lithium that goes into the batteries for electric vehicles, even the bear case on the growth and demand for lithium is that we'll see a 9 times growth in demand for lithium over the next 7 or 8 years. So it points to the fact that it's not just technology, there's a lot of other parts of the economy that benefit from these long duration companies. One of the other areas is even, we talk about digital payments because I've got a chart on that, but we think about how often we use our credit cards or how often we're using our phones to do things for us. And in Europe and the US, we're way behind what's being done in China. In some cases, backwards of how things normally work, but we'll get to that in a minute. But the whole payment system is fascinating, one, again, where there's lots of opportunities to invest over the long term. We just think there's, again, this is more specific in terms of what are the disruptive areas to be invested in. Again, kind of more food for thought than anything. But you can see, we talk about e-commerce, I've mentioned autonomous cars, but artificial intelligence, which plays into so many different areas, but the big area that people don't often think about in artificial intelligence is just not the autonomous driving car, but just the car that we all drive, where there's tremendous amounts of innovation and technology being invested in that to help us be safer, to help the car intuitively know what's happening to, is that person next to me, are they going faster or slower? Are they going to turn left or right? And again, this is a huge area of growth for chip makers, for example, that play in the artificial intelligence area. Maybe mention e-commerce as one because we all, at least we talked earlier about Amazon Prime, just passed 100 million members, mostly in the U.S. Is it inflationary that they're raising their prices $20 or 20% over the next year or so for Amazon Prime? It could be. But we think there's still a long path. That the last time that they raised prices, there was very little pushback from Netflix recently on a price increase. But Amazon today, even though it's had a huge run and it participates both, as you know, in e-commerce and in the cloud, it still, interestingly, only touches about 7 or 8% of the addressable market market for the retail where we order our books and toothbrushes and things of that sort, and even less in the cloud. So for a company that's done so well, still a very long path for growth over many, many years. Now, one of the questions that comes up is about regulation on some of these big growers, and of course, it's natural that the regulators would look at these companies that have grown so quickly and for so long, and they will continue to look at them. One of the things we would think about is that, take an Amazon as an example. Their whole motive is to drive prices lower. So it's not gouging or not hurting the consumer, we don't think. The level of satisfaction of users of Amazon is extremely high. But there will be a lot more talk, a lot more concern, and maybe some regulatory issues, but we don't see anything egregious with a name like that. Just my comment on China, you can see using the WeChat app from Tencent, how many daily users there are, and how the path for growth here is huge, and this will become more of an everyday usage for us, not WeChat, but other motives for us to do e-commerce, social media, kind of in one platform. We're just at the infancy of that. Again, another point here, just as this disruption occurs, we talked last night at dinner, Dave mentioned disruption of the washing machine and how long it took that to go from zero to being in 80% of the homes, and it was probably 30, I think you said 30 years. It changed people's lives, made the housewife more productive. We see this disruption occurring, obviously continuing, but it condenses the amount of time between startup and when it's a huge percentage of users everyday use, and just using the smartphone as an example. Here's some things we see occurring, and again, I've talked about all these a little bit. Here's just an example of the disruption you can see in mobile payments, again, using China and using the U.S., where there's huge opportunities for growth for the U.S. consumer, and then, of course, the European consumer would be very close to what you see for the U.S. I'll just skip to the end in view of the time, but again, there's so darn much negativity out there. We hear it on CNBC every day, and the experts in the field, and it's easy to be negative. There's always something out there that you can hang a hat on and have a reason to be negative. And maybe it's the climate we live in. Maybe it's the fact that we're in a long part of a strong market. But the fact is, we think there's a lot of other reasons to be optimistic, some of which I've shared with you today, just a couple of other reasons why we think it's a good time to be optimistic as well. So thanks very much.
Thank you, Rick. I'm Joe Zidle, investment strategist with Blackstone. Also want to share my thanks for having me here today. I appreciate being here for a lot of reasons. I've got young kids, so being in a hotel means a good night's sleep. That's number one. I don't necessarily tell my wife that, but I do appreciate being here for a lot of reasons. What I thought I'd do is just spend the next few minutes on our view of the world for the remainder of 2018 and beyond. And then I think after I wrap up, we will move to questions. So I look forward to taking questions as well. And just by way of a starting point here, just a little bit of background. So I joined Blackstone a little bit earlier this year, in January this year, to be the firm's investment strategist. And Blackstone is the world's largest alternative asset manager. We have about $440 billion assets under management. Divided principally among 4 different businesses. Private equity, where we're the largest private equity owner in the world, with about 99 portfolio companies that employ about 550,000 people worldwide. Real estate, where we're the largest real estate investor in the world. hedge funds, where we're the largest hedge fund allocator, and then credit. And my role as an investment strategist is to support all of the businesses with respect to investment strategy and research, as well as sit on the investment committees, and then lastly to help kind of create the themes and investment ideas and communicate that to the public. So in terms of just an overall view, as a starting point, I think I'd pick up where Rick had left off with expressing my bullish outlook, our bullish view on equities for the remainder of 2018 and beyond. And the reason for that bullishness, really in one word, is earnings. We think we are still in a pretty terrific earnings environment. S&P 500 earnings just wrapped up this quarter. I think we're going to end the quarter somewhere around 23.5% EPS growth year over year. And that earnings story is one that's not just contained to the United States. We're seeing very strong earnings growth in emerging markets. Europe's earnings they've at least passed their peak growth. They're rolling over, but still relatively good rates. And so overall, this has been an earnings-driven bull market. In the second or third quarter of this year, we're probably going to see the earnings growth rate in the U.S. start to slow, and that's very normal. When you look at a business cycle itself normally from trough to peak is only 7 quarters long. It's much different than an economic cycle. An economic cycle is much more long and drawn out. A business cycle's got greater periodicities. In other words, you've got greater peaks and troughs. And so it's very normal to think that 8 or 9 quarters after the last trough in earnings, we're going to start to roll over. In the second or third quarter, the earnings growth rate will slow simply because the year-over-year comps end up getting very, very difficult. And investors have kind of looked at this peak earnings, and I think they've somewhat misinterpreted it. And I think that was helped a lot by Caterpillar on their earnings call a couple weeks ago when they talked about peak earnings. Most people interpreted that to say, okay, stocks are now going to fall. And when you x-ray our companies, our portfolio companies, we're seeing a lot of the same trends in terms of earnings growth and revenue growth. And in the last quarter, we saw the fastest earnings and revenue growth that we'd seen for our portfolio companies pretty much in their history. But having peak earnings is much different than earnings actually rolling over. And what's happening is the growth rate's simply just starting to decline. We think earnings are going to continue to grow, and we think 2018 we'll see S&P earnings around $160, which means the market's not overly expensive. But typically when the growth rate starts to roll over, it doesn't mean you're necessarily going to get a pullback. It doesn't increase the odds of drawdowns or 10% pullbacks or anything else. It just means normally you get a change in leadership. So a little bit earlier this year, the market was spooked. We saw that 10% plus pullback. And if you look at the history of volatility, what you realize is 2 things. Number 1, volatility happens. And number 2, it tends to happen more often than people think. If you just look at the S&P from 1960 to today, the data will tell you that on average about 4 times a year, the market's going to fall 5% or more, right? Sometimes it's because, if you go back a couple years ago, Russia invaded Ukraine, markets fell. Maybe someday Ukraine gets lucky, they invade Russia, markets will probably fall. The data will tell you that basically once every other year, the market's going to fall 10% or more, right? We saw that beginning at the end of January with the stronger average hourly employment print, where the market, that triggered a 10% plus sell-off. Before that, it was January, February 2016 when oil prices were cratering and China was going to have a hard landing. Before that, it was it was in 2014, and that was the Ebola crisis in the United States. And I don't want to make light of Ebola because I'm sure it's not fun, but here's a stat for you. More Americans have married Kim Kardashian than died of Ebola. That is a fact. I have some disclaimers that I'll show later that will say that Blackstone doesn't necessarily prove everything that I say. That's all right. They can disagree. Point is, this is, I think, a very normal run-of-the-mill pullback. And I think if investors are patient and they hang on, we think the markets are going to close the year higher, and I think the 2 strongest performers out there are going to be the U.S. and emerging markets. The biggest pushback that we get to our views are not necessarily on the earnings side of the equation, but it's interest rates. And our view is that rates will continue to head higher. We think the 10-year Treasury yield is going to move higher. We think it could easily hit 3.25% to 3.5%. And most people look at that and panic in terms of equity valuations and say, well, it's impossible for stocks to go up with higher rates, and they get all weirded out. But I think that misses a bigger point, and that's the effect that higher rates are going to have on fixed income portfolios. Because history will tell you that on the equity side of a portfolio, companies can adjust, right? When rates are moving higher, when you've got the early stages of inflation, that's a time when materials, industrials, energy, discretionary, those sorts of things tend to outperform. Emerging markets will also tend to outperform. But most people are looking at rates rising thinking, what's it going going to do to equities, but what they're ignoring is that investors are massively overweight fixed income. Not only are they overweight fixed income, but they're longer duration. The 10-year Treasury yield hit an all-time low in June of 2016 when it hit 1.35 or 1.37%. And from June of 2016 to last week, U.S. investors had pulled $173 billion out of U.S. equity mutual funds and U.S. equity ETFs combined and put over $500 billion into fixed income. And if you look at those flows, where the money actually went, it went to intermediate and longer duration fixed income products, whether it's on the ETF side or bond fund manager side. The durations, whether investors are acknowledging it or aware of it or not, durations have been extending at a time when the 35-year plus bull market in bonds is over. Right? This was a bull market that started in 1980 when the 10-year Treasury was at 15.5% and ended in June of 2016 when the 10-year Treasury hit 1.35. And I think what investors today are not prepared for is that we could see a secular bear market in bonds. And if you look at the rate regime over time in the U.S., it's been remarkably stable. We had a 40-year bear market in bonds from 1940 to 1980, and then a 35 or 36-year bull market. And most investors have not invested in a secular bear market in bonds. And so our view is that the real risks to portfolios are not necessarily, the higher rates on that the impact will have on equities. It's that investors aren't prepared for it in fixed income, right? Because they've got longer and longer duration, and they've done it because either A, they don't believe the growth is real, or B, they're just believing that, the lower for longer sort of refrain. And when we make the argument for higher rates, most people say, well, lower for longer. They'll say, well, rates haven't gone up yet, so they won't. Well, prior to January 26th, if someone said, hey, let's invest all we have in the Russell 2000 because stocks haven't gone down yet, so they won't, I'm pretty sure we could poke a hole in that argument. But yet, for some reason, people will embrace that on the fixed income side of a portfolio. So in our view, there's a couple things that are going to drive rates higher. Number one, I think it's inflation. And we're seeing it in a lot of different ways, right? Not broad-based inflation, but we're seeing a lot of different pockets of it. On the, Rick mentioned Amazon Prime. There are 90 million U.S. households that are going to be paying 20% more to get their paper towels and toothpaste delivered for free and to binge on TV shows, whether it be The Wire or Sneaky Pete or some of the other things I was doing last night flying over here instead of sleeping. So I'll apologize if I'm speaking fast, but I had a lot of coffee over lunch. Point is, we see higher oil prices, higher prices for things like Amazon Prime, higher gas prices, and at the same time, wages, I think, are set to move higher. And the wage debate is something that I think there's very little consensus on this. Most people will acknowledge tight labor markets, but they say there's no wage price pressure yet, right? Because wages have been rising at a disappointing 2.5, 2.6% per annum rate. And when you x-ray our companies, for instance, and I look at a lot of our company data in terms of all the portfolio companies we own, one of the number one concerns for our CEOs and CFOs is hiring. And what we've seen is our companies going down in age and skill levels in order just to fill bodies. And there's a certain desperation out there in labor markets. And if you look at last week's employment data, a lot of people got stuck on the headline number of 3.9% unemployment in the U.S. One of the things that I think is so interesting is if you lift up the hood on that, what you find is that the unemployment rate for teenagers, those that are aged 16 to 19, fell to 13.9%, the lowest level in basically 20 years. In 2010, that unemployment rate was 27%. Right? It's amazing that teenagers are now moving into the job market in a way that we haven't seen since the mid-1990s. The workforce participation rate for teenagers moved up really for one of the first times that we've seen in the history data. What are kids doing these days? I don't know. Fortnite seems to be a very popular game in my house. My kids are on the couch. They love it. Right? But there's a lot of other kids that look like they're getting off the couch and getting into the job market. And we see that among the macro data. We see that in our company data. And I think there's an inflation story here, a wage story here, that is going to start, I think, accelerating. And historically, higher wages aren't necessarily all that bad for the market. It's only when average hourly earnings cross over 4% per annum that you start to get real no inflationary pressure. So I think we're in the early innings of an inflationary cycle, and I think that's going to be very good for the cyclicals, materials, energy, industrials, as well as emerging markets. A couple other points I'd make real quick. Number one is CapEx, and this has been, I think, a pretty hotly debated topic, and for the most part, the debate's been, or the question's been, where has all the CapEx been? Where has that gone? And if you look at it, companies can either buy growth or invest for growth. And the last 3 years, we saw M&A over $3 trillion a year for each of the last 3 years. M&A this year is over $1 trillion. It's on pace to set a record. So in other words, companies haven't wanted to invest for growth. Instead, they've been buying it. But if you look at the average age of equipment in the United States, the machines that produce the goods and services, what you find is that equipment today is older than it has been in any period going back to the 1960s. Right? The average age of a machine that's in place in the United States today is 23 years. That means it was purchased in 1995. Right? When some of us were waiting in line for tickets to go see Hootie and the Blowfish, because that's what I was doing in college, Windows 95 was brand new. Fresh Prince of Bel-Air was still on TV. For any of you that are fans of Will Smith, go figure. We don't judge. This is a safe place. Point is, that equipment's old. We're seeing bottlenecks all throughout the manufacturing and delivery supply chain. And you take old equipment plus bottlenecks, an accelerating economy, and a tax incentive for companies to do CapEx. And I think that CapEx story can be the next leg of this cycle. This is classic end-of-cycle stuff. It's typically when you see CapEx come online. I think that pushes growth ahead of potential for a while. And I think we end up seeing pretty strong growth out there. And I think overall it's a pretty good environment for companies. So I think that's a story that we're going to begin to see. We're already seeing it at the company level. The last thing I'll mention before I turn things over to our panel discussion is a longer-term concern, and that is technology. And specifically, it is China versus the U.S. in terms of being the technological innovator in the world. And, for a long time, the U.S. has hung its hat on really being the world's leading tech innovator, right? We certainly couldn't be the low-cost producer, so we were the innovative producer. But if you look at China and everything that they're doing today, they're set to surpass the United States and take over not only the manufacturing title, but the manufacturing and innovation and technology title. And in 2019, China will surpass the United States for the first time ever in terms of R&D spending, research and development. And if you look at China's policies, whether it's the One Belt, One Road initiative or whether it's Made in China 2025, what you can see is that their policies are really geared toward technological innovation. It's something that they need to do. Why? Because they've got about 400 million people that they've lifted out of poverty into middle income, and now they're facing the classic middle income trap, which is to say it's easy for an emerging market to go from low income to middle income, but it's much harder to make that jump from middle income to upper income. China is going to do it through technological leadership, through biotech, research and development in other areas, and they're expanding. They're spending at a time when the U.S. is cutting it back, and I think that's going to have profound changes in terms of geopolitical sort of balance of power over the course of the next 10 to 20 years. I don't know how the U.S. is to combat that or offset it. I don't know how developed markets do it either. But when you look at what's going on in China, whether it's electric vehicle batteries, the lithium production, whether it's supercomputers, 5 years ago the U.S. had 3 of the fastest supercomputers in the world. China had none. Today, the U.S. has 2, China has 2, Switzerland has 1. All right, last year, they graduated 4.6 million students with degrees in science, technology, engineering, and math. The U.S. graduated 560,000. And 1 out of 5 college kids today in the world is from China. So not only do they have state-sponsored programs that are going to drive their technological leadership, but they're producing the educational requirements, giving the students the tools that they need to drive that further. Some people argue you can't have communism or authoritarianism and creativity. I would argue that people are taking a too narrow view of that, and they're maybe relying on history, but they're ignoring what's happening right in front of them today. So I think that's an issue that keeps us up late at night over the long term. So with that, I'll stop there. Love to turn things back over to Don for a round of Q&A. Thank you.
Okay, thank you, Chris, Rick, and Joe. Do we have questions from the audience? We'll be able to take a few before we run out of time here. Let's see.
I'll go back to my youth when I was a Chinese history major at Villanova. How do you get the culture of productivity, Joseph, that you see in Silicon Valley in a society that is becoming more regimented for the simple reason that exactly the characteristics that you have just articulated in China are the single biggest threat to the party? They cannot innovate, they cannot grow without the party eventually being put aside. And they know this. This is exactly why Xi is doing what he's doing. He has to get control now. He can't wait. Their biggest threat is the freedom that all of their people want. How do you reconcile that with your view?
Yeah, it's a good question. Thank you. And, I think the conventional wisdom argues that you can't have creativity, right, with communism. And, some people might question, say, the arts, but if you look, at writing, at arts, and at other sort of social issues and social programs, you are seeing an evolution. You are seeing sort of more creative forces at work. And I think your point on the Communist Party, what you're seeing now is that they are moving into companies, taking 1% stake in technology companies, for instance, in order to further streamline and control what's going on. I think it's a very interesting debate, and what we've seen so far is, the number of, say, private equity firms in China is growing. Number two, the number of billion-dollar startups. When you look around the world, the fastest number of billion-dollar startups is occurring in China. So I think it's a fair question, but the data that we see out there says it's happening. Regardless of one's sort of priors saying it's very, very hard to reconcile the two, it is happening. They've got a larger problem, which is not necessarily the leadership, but the larger problem is what to do with everybody that they've now thrown into the middle class. And I think they understand that technology is the way to address that.
Precisely.
So,
you have revolutions
Yeah.
in times of rising expectations, but my point is, when you look at Chinese data, you can't extract from it those portions that make economic sense and those portions that simply represent the allocation priorities of the party. Like as Mike was saying before, they want all of the activity to go to the other side of the country, and the party has mandated this will occur. But there's so much wasted investment and activity simply because the party looks at everything politically. Even though they take a lot of time, they look at things in a technical way, they look at things in an economic way. Ultimately, the decision is political. That's it. And until the party is removed, that's how they're going to look at everything. Building aircraft carriers, whatever it is.
yeah, and the political initiative number one, Made in China 2025, puts technology at the center of that, so I think it will continue to develop. But fair point. Thank you.
Other questions from the audience, Paul?
Joe, I would qualify you as an optimist. I'm particularly happy to hear about your CapEx expectations. But if, in fact, we're looking at increasing productivity and innovation, further rise in the stock market, how is the Fed going to react? And when does the Fed take away the punch bowl?
Yeah, great question. I certainly invite anyone else here to respond. But my reaction is I think it puts the Fed in the crosshairs of the president, in that you're going to have a Fed that's going to have to hike more aggressively than people think, and you're going to have a president who's going to want lower rates for longer. So I do think it sets up a tremendous tug of war. Most people will think that further Fed tightening is going to drive the next recession, which means rates are going to go lower. And, the view that the 10-year Treasury yield could be, sort of at the beginning of a secular bear market, most people would argue that you can't get a bear market in bonds simply because the Fed's going to cut and the 10-year Treasury is going to go back to 2%. I think the yield curve could actually steepen because we could see the 10-year Treasury yield move up higher and higher faster than the short rates, and then the Fed will, in my view, have to hike more aggressively. So if anything, this last sort of cycle, and whether it be a CapEx-driven cycle or maybe some other inflationary pressure drives faster growth, I think it could actually elongate the cycle, meaning that we could actually go longer before the yield curve inverts versus shorter. So, thank you.
Rick, did you have some comments?
I should have stepped in on the other, to China, just briefly. Two of the most innovative companies in the world are in China, Alibaba and Tencent, and there are a lot of other companies feeding off of them, and they're buying a lot of innovative companies. So it's certainly worth thinking about. But on we think about the 10-year, we're all just obsessed, or we're being told to be obsessed about the 10-year at 3%, but it's still at a, historically a relatively modest level on all different ways that we look at. Strategist has put out some great comments on that. So I don't know that the punch bowl has been, maybe it's been effectively taken away, but I think certainly there's room to go.
Chris, did you have any comments on interest rates generally? Would there be anything that would make you more or less optimistic?
So, I mean, our view has tended to be that as we look forward, it becomes more and more important to manage, and we're in the ETF world, so we've seen the proliferation of just different tools that now, in some senses, people can use to manage risk in portfolios, in other senses, they can use to get themselves maybe into a bit of trouble that we saw in, say, February with the VIX. And so, ultimately, some of the stuff we'll tend to look at will be the performance of, say, factors at different points in the cycle. And as we've seen what's happened with the market and with interest rates and with what central banks and the Fed are ultimately doing, we've definitely seen, and it's been alluded to with technology, a momentum-led and momentum-driven rally, and that tends to confirm the view that we all largely have, that we're longer in the tooth with this current cycle. And if we're thinking about where to position going forward, that's really where we spend the bulk of our time looking. I know my presentation didn't mention it at all, but the idea of sort of growth at a reasonable price, a quality tilt to a given equity portfolio, healthier balance sheets, that's kind of where we're looking more so than momentum. That doesn't necessarily mean that momentum can't lead the way for the next 3 to 6 months or even longer, but ultimately we look to areas that have maybe underperformed the market in the near term, maybe outperform in the future.
So we're going to have to stop there. Thank you very much to everyone. And I'll invite Kathleen Stephenson up to bring up our next panel.